Following on from last time where we studied a correlation heat map across 40 different assets, we now move on to a different aspect of correlation. This is the correlation that exists between different time frames that you're trading. And it's equally important because if you get it wrong and the correlation between those time frames is too high, this will put increased risk on your portfolio. Stay tuned. When traders think about correlation, probably the first thing that comes to mind relates to the assets that are being traded, but this is only one aspect of the bigger picture. The impact of correlation can take multiple forms, and one of those is that between time frames, the time frames that you're trading. So for example, you might have developed a trading strategy that works well in the M15, H1 and H4 timeframes, and therefore probably in all of the timeframes in between also. But should you trade all of these in the same portfolio? What if the correlation of the equity moves is so large that it means you experience larger drawdowns as a result of trading all the timeframes? Well, that is the subject that we'll be looking at today. Let's make a start. Now, the first thing I need to explain is the way that you calculate the correlation for something like a time frame based study, because this is different to the approach you take when measuring the correlation between assets. If you remember, there you're looking at the difference over each time interval of each of the two assets and then calculating R squared based on those values. Whereas here, the approach that I've taken to measure the correlation between time frames is instead to use the equity curves of the trading strategies that are trading those time frames. So as an example, the chart that you see here is the equity curve that was produced by trading the same strategy with the same parameters, one off a 5-minute chart and one off a 6-minute chart. Now, I've chosen those two time frames to be very close together intentionally to show you the effect that this has. So the blue line here is the 5-minute and the orange line is the 6-minute. But of course, we're not just interested in whether these equity curves look similar. We want to quantifiably measure when they're both experiencing a drawdown at the same time and when they're both making new highs at the same time. And to do that, we use a similar concept where we look at the equity difference. And as you can see here, whatever happens to the equity over a set period of time is the value that we'll use in our calculation. And when we do that for each time frame, we can then plot those values in a scatter plot as shown. So every dot that's in this top right hand quadrant is a period of time where both equity curves moved up. This bottom left quadrant means that both equity curves moved down at the same time, and then the bottom right and top left quadrants represent times when the equities moved in opposite directions. And as you can clearly see from this, generally they move in the same direction the majority of the time, which indicates there's likely to be a high level of correlation. If we now calculate the R squared value for this, it comes out at 0.57, which is the value that you can see here and here in the heat map. So just explaining this in a little bit more detail, across the top, we've got all of the time frames that I tested, and then we've got the same time frames down the left-hand side here. So clearly the correlation between M5 and M5 is going to be 1, showing it's a perfect correlation, but then the values below that will show how correlated this is to other time frames. So as you can see, the highest correlation is with the M6 chart, which you would expect because they're so close together. The correlation then begins to fall away until eventually the correlation with the higher time frames is actually very low. If we now take a look at one of the higher time frames, so let's look at the H4, we can see that this has low correlation with all of the time frames up to H1. And this only really begins to show any signs of correlation when compared to the H2 chart. So what does this information tell us? Well, all of these orange and yellow areas indicate time frames that are so close together that they exhibit those moderate levels of correlation and therefore might increase the risk of the portfolio if we were to trade those together. But do remember that these results might vary for different types of trading system. But what I have deduced from this particular heat map is that it looks like it's a factor or a multiple of 4 that's required in order for the correlation to reduce to an acceptable level. Let me show you what I mean. If we look at the 20-minute chart, this shows relatively low correlation with the M5, but then as soon as you go to M6 and M10, that correlation starts to increase. And so the multiple between M20 and M5, which of course is 4, in this case tends to guarantee that that correlation will be relatively low. If we go the other way, we can see that this occurs on the H2 chart. And so in this case, it's actually a multiple of 6. If we do the same for the H1 chart and see how that relates to other time frames, we can see going higher, we have to go up to H4 in order to get low correlation, which of course is that factor of 4 again. And then going down, it's either M15 or M12, which again is approximately a multiple of 4 in the other direction. So the information that I'm taking from this study is that really the different time frames you're trading in a single portfolio ideally will be at least a multiple of 4 between each other. So this, for example, could be M15 and the H1 and the H4, or maybe H1, H4 and the daily. But of course, you'll have to come to your own decision around what you consider to be acceptable correlation and what you don't. And once again, please bear in mind that when you do this, you should undertake this exercise yourself with your own trading strategy, which may well give different results to those that you've seen from me today. So thank you for listening today. I hope you found that useful. If you have, then please do remember to give me a thumbs up. And if you're not already subscribed to the channel, then please do consider that, and you'll be notified when other content like this gets released. And now, until next time, trade safe.